Welcome. In this video, we will analyze what happens to Xcn coin if the rally happens again. Don't forget to subscribe and like, and please watch to the end to understand. One of the most basic and reliable indicators when analyzing the price movements of an asset is undoubtedly how the price forms bottom and top structures. This method, which is frequently used in technical analysis, provides investors with very clear information about the direction of the trend. Especially in short and medium-term investment decisions, tracking the lows and highs plays a critical role in predicting trend reversals or continuations. In this context, especially when a structure that starts with a downtrend signals a reversal, it is a situation that should be carefully examined. In order for us to say that an asset is in a downtrend, we basically observe the following structure. The price exhibits a downward pattern by continuously making lower lows and lower highs. This behavior shows that sellers dominate the market and buyers have yet to take control. Each new high is more subdued than the previous one, and each pullback confirms weakness by making a deeper low. As long as this cycle continues, the downtrend is active and buying is considered risky. However, when this structure starts to break down and the market forms a higher low followed by a higher high for the first time, this is a harbinger of a very critical development. This is because the price is now abandoning its previous bearish characteristics, and buyers are starting to regain power in the market. This newly formed structure is called a trend reversal, or bull signal in technical analysis. In particular, such structures can provide traders with buying opportunities. The formation of this structure represents not only a technical reversal, but also a shift in the psychological balance of the market. Investors who had previously panicked on dips are now hesitant to sell because the declines are now limited. At the same time, new buyers recognize this structure and enter the market. The renewed strength in demand puts pressure on supply, which pushes the price up. Thus, the foundations for a new uptrend are laid. For traders, recognizing such shifts in structure and time can offer great opportunities. Because these early stages of a trend reversal often have the highest potential risk-return ratio. While the price is not yet fully bullish, these technical signals of a trend reversal allow traders to take early positions. As a result, when an asset starts to make a higher low and then a higher high for the first time after forming falling lows and falling highs for a long period of time, this indicates the beginning of a technical transformation. This may indicate that the balance in the market has begun to shift and that buyers are now coming in stronger. But this is not the only way to judge the analysis. Let's look at the other metrics. Stay tuned. One of the most notable technical structures on the chart at the moment is the prominent falling trend line. This trend line is a line of downward pressure that the price has been building since its previous highs. So every time the price tries to rebound, it encounters this falling line and is subjected to downward pressure again. In technical analysis, such structures indicate that sellers are still active in the market and that buyers have not yet fully seized power. Therefore, these levels are insufficient to paint a hopeful bullish picture unless the trend is broken. The fact that this downtrend is still valid shows that the price is still moving under pressure, and it is too early to talk about a clear upward trend reversal. Because in order to talk about a bullish or positive momentum in technical analysis, the price must first break this falling trend line with volume and determination. Otherwise, every upward movement may remain as a correction wave or a temporary reaction, and the price may continue in the same downward trend. For this reason, it is extremely important for traders and those who trade with technical analysis to keep a close eye on this level. The importance of the trend line here can be summarized as follows. This structure has turned the price down on many previous attempts, each time leading to new lower highs. In other words, a kind of invisible but very effective line of resistance has formed in the market. Now the price is consolidating just below this line. That is, it is showing a horizontal squeeze around this line. This suggests that the market is in the decision phase and a major breakout is approaching. However, at the moment, there is no clear close above the trend line, so it would not be correct to say that this bearish pressure is technically over. On the contrary, the fact that this line is still active means that at any moment the price could start a downward wave again. If this trend is not broken and the price is rejected again, then there is a risk of starting a new bearish move. This means that we are in a period of caution for traders. Breaking such falling trend lines is very important, not only for the trend direction to change, but also for the market psychology to transform. Because when this break occurs, many traders take it as a signal and start taking positions. Thus, the price finds support both technically and in terms of volume, paving the way for an upward movement. However, this is not the case at the moment. Since the breakout is not yet clear, it is useful to be cautious. One of the most important signals for a breakout is at least 2 or 3 candle closes above this trend line. These closes should preferably be on volume, and the price should show a decisive upward progression. In this case, the downtrend will have ceased to function and traders will be able to buy more safely. Otherwise, if the breakout remains weak or the price moves back into the trend, this could turn into a bull trap and the price could fall sharply again. To summarize, this falling trend line, which is still active on the chart at the moment, stands as the biggest technical obstacle to bullish scenarios. The fact that the price has yet to break this trend indicates that there is still selling pressure in the market. If traders want to see a safer and more robust uptrend, they must first see this technical barrier broken. Otherwise, any bullish attempts may remain short-term and indicate that the bearish structure continues in the big picture. Therefore, a clear upward break of this strong falling trend line is essential for the price to end this downtrend completely and start a new uptrend. Until this breakout does not occur, the best strategy is to remain cautious, manage positions with minimal risk, and wait for more solid confirmations. The 200-day exponential moving average is one of the most fundamental indicators on the chart and is a critical reference point for long-term traders and those trading with technical analysis. This indicator is often used to determine the general direction of the market, and the presence of an asset above or below the 200 EMA gives important clues about the strength of the trend in the market. In the current situation, the fact that the price has been moving below this important level for quite a long time suggests that there is still pressure in the market and that buyers are not yet in full control. A price below the 200 EMA is also a negative for investor psychology. It usually indicates that a downtrend is underway and that the market has yet to recover. Staying below such long-term averages in technical analysis can also paint a negative picture for large institutional investors. Therefore, many investors wait for the price to break this level to the upside and settle firmly above it. Once this happens, there will be stronger signals that the trend direction has changed, and the possibility of a broader market recovery will start to be discussed. Looking at the current price action, we can see that the price is attempting to move closer to the 200 EMA. However, breaking above this level may not only be a short-term bullish move, but also a sign that the market is entering a structural transformation. Because when closes above the 200 EMA start to come, there is now serious technical evidence that the trend is turning up. This could lead to bigger buying waves and the potential for a large upside move. Such a breakout is not only a breakthrough in terms of technical indicators, but also the crossing of a psychological threshold. Given that the price has been suppressed and holding below this average for a long time, a break of this level could embolden buyers and bring more capital into the market. This would naturally set the stage for strong rallies on larger time frames. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.